footworks, they are stocks that are likely to open up in the red.
All right, let us listen into what Fed Chair Powell had to say on the rate hike and, of course, the motivations behind another 75 basis point hike. Listen in.
I don't have any sense that we've over-tightened or moved too fast. I think it's been good and a successful program. That we've gotten this far this fast. Remember, though, that we still think there's a need for ongoing rate increases, and we have some ground left to cover here, and cover it we will. We'll want to get the policy rate to a level where it is where the real interest rate is positive. We will want to do that. I do not think of it as the single and only touchstone, though. We're now 18 months into this episode of high inflation, and we don't have a clearly identified scientific way of understanding at what point inflation becomes entrenched. It used to be that you would raise the federal funds rate, financial conditions would react, and then that would affect economic activity and inflation. Now, financial conditions react well before, in expectation of monetary policy. That's the way it has moved for a quarter of a century, is in the direction of financial conditions, then monetary policy, because the markets are thinking, what is the central bank going to do? If we were to over-tighten, we could then use our tools strongly to support the economy. Whereas if we don't get inflation under control because we don't tighten enough, now we're in a situation where inflation will become entrenched, and the costs, the employment costs in particular, will be much higher potentially. So from a risk management standpoint, we want to be sure that we don't make the mistake of either failing to tighten enough or loosening policy too soon. I would say a big channel is the labor market, and the labor market is very, very strong, very strong. And households, of course, have strong balance sheets. And so we go into this with a strong labor market and excess demand in the labor market, as you can see through many different things, and also with households who have strong spending power built up. So it may take time. It may take resolve. It may take patience. It's likely to get inflation down. I think you see from our forecasts and others that it will take some time for inflation to come down. It'll take time, we think.
Ed Yardeni is president at Yardeni Research, and Dean Kim is head of global research product at William O'Neill. Gentlemen, great to have both of you here. Thank you very much. Ed, so this is pretty clear, right, where they want to go with this. So into 2023, he's strongly pushing back on the idea which markets have that we will see rate cuts. So maybe slower pace of hikes, but where we get to will be higher, and then we'll stay there for longer. What's your sense about the market reaction from here on?
Well, I think first and foremost, we should point out that this was all about Powell's interpretation of events and of policy. Clearly, he's the chair, so he's very influential. But let's not forget, there was about a week ago, there was an article in the Wall Street Journal that reviewed that several Fed officials on the FOMC were inclined to start to think about slowing the pace of increases and maybe even pausing. And so we're about to get a whole deluge of Fed officials following up on what Powell said. And I won't be surprised if quite a few of them try to push back on the uber hawkishness that Powell expressed. I think he's had a real tough problems communicating the Fed's intentions because there's too many of them speaking too often. But I still believe that they are going to do 75 basis points in December. That was my belief before. It's my belief now. And I believe that they're going to have to pause early next year simply because we're talking about a major, major increase in the federal funds rate in just 10 months. And I think they need to pause for a while just to see what impact this is having on the economy. And I am reminded of some Fed officials just recently saying that they have to start thinking about stepping down from the pace of increases. And Jim Bullard, who's very often leads the way, he's the president of the Federal Reserve Bank of St. Louis, he very often has anticipated what his colleagues are going to do. And he was promoting the idea of two big hikes in November and December and then pausing.
Okay. Dean Kim is also with us to give us his view. Dean, good morning. This rate tightening cycle has been on for the last 18 months, right? And through that period, markets like India have not only been resilient, but have also almost hit new highs. How high is the probability that despite the Fed continuing to raise rates, Indian markets will continue to trend higher? I mean, as of now, we've not seen any correlation with rising rates and falling equity markets. So what do you think would be the way forward?
Well, Indian market certainly has been very resilient. And I think last time I was on the show, we were talking about how the market should find support or try to look for support at the 200-day moving average on the Sensex, and it did that. And I continue to be impressed by the underlying fundamentals for the country. I think a couple of things we need to look out for. One is continued dollar strength, and as well as where Indian rupee is going, as well as the oil price. But from our perspective at William O'Neill, we certainly look at technicals very much. And one thing I would say is there's a lot of stocks breaking out in India at the current moment. A lot of spaces looking really good, but at the same time, there are some extended stocks. So I would say for those stocks that are, let's say 40% above the 200-day moving average, perhaps it's time now to start to take a little bit of profit and trim some position. Because we're seeing reactions in other emerging markets, Asian markets opening up lower. So that may be a trend for a little while. Certainly, the Indian market looks a bit toppish, but certainly, I don't see any kind of signs that Indian market should take a major hit. There's no fundamental data point to support that. So I would say, take some profit on overly extended stocks, and then perhaps switch into stocks that are breaking out from stage one base. There's a lot of opportunities.
All right. Hi, Dean. Morning. I recall that call you made. 200 DMA, Nifty is likely to take support, and we did, and we bounced off there. Do you think that there is a possibility we revisit those levels? That's 1,000 points away from current levels. And also, you briefly mentioned about the dollar index. Since you're also tracking technicals, what's the outlook out there? It's at around 112 today.
For the dollar index, certainly, we may see another test in terms of the highs on the dollar index. But as Mr. Yardeni kind of pointed out, I'm of the belief as well that heading into next year, we'll probably see the Fed kind of pausing, because if you look at the inflation break-even rates for 2023. We're looking at a range of 2%. So if that's going to be correct, and if the bond market is correct, we should see the Fed kind of backing off, and we should see the dollar reverse. So, I think it's short-term pain, but we have to get through this period. And in terms of the Sensex, we do see a lot of support at around the 21-day moving average. And that's only like a few percentage points away. 200-day moving average is 6% away, but I think there's going to be a lot of support around, let's say 59,400 at the 21-day moving average, or the 59,000 at around 50-day moving average.
Okay.
Ed, so broadly, I mean, is it going to be, the markets under pressure globally, Ed? What's your sense? And despite, what you're saying, and you're right, we hear so much from so many speakers, it's tough to make out who to listen to and not. Maybe they should just have lesser people speaking. But despite all of that, as you said, the chair is Mr. Powell, and he's very clear about what he wants to do here.
Yes. Well, I sometimes refer to the FOMC as the Federal Open Mouth Committee. There aren't many of them that are just too anxious to speak. And I guarantee you, we're going to have just one speaker after another in the next several days. And I suspect quite a few of them are going to be more dovish than Chairman Powell. I mean, Chairman Powell really just came out with the most hawkish position. I would call it Volcker 2.0, basically saying, we're just going to raise interest rates until we find the level that starts to convincingly bring inflation down. And that is Volcker 2.0. And I thought there was some indication that they were trying to kind of walk that back a little bit. Let's call it Volcker 1.5. But here he once again just pounded the table that by all means they have to bring inflation down. And the only way they can do that is by pushing up interest rates. And if they push them up too high, they can always push them back down to revive the economy. But look, I'm concerned that they made a big mistake by not moving fast enough to get catch up with the inflation curve. And now they may be overreacting to that mistake and creating another problem. It could be a financial crisis, which is what the yield curve is telling us. Inverted yield curves are pretty good at predicting that if monetary policy continues to tighten, something's going to break. I don't know that it's going to break in the U.S. because the U.S. credit markets, capital markets, banks are actually in pretty good shape ever since the 2008 calamity. But clearly there are weak spots in Europe. I think China's got its issues. And of course, emerging markets get under a tremendous amount of stress when the dollar gets to be too strong.
Okay, well, we were just talking about how the word pivot has been overused, right? But guess what? Since 2020 is when pivot was the word of the year, as per the dictionary. So, I mean, it's been going on for, 2 years now. Thankfully, we don't have to use it anymore, at least for the time being. But Ed, just one final word from your end, right? What do you see as the way forward for the Indian market? Would you put fresh money to work now? Would you be cautious? What's the approach? And for emerging markets as a whole?
Are you asking me or,
yes,
or my co-panelists?
No, that question is for you.
Yeah, I think India definitely stands out as performing remarkably well in this kind of environment, which really tells you that the underlying fundamentals are giving global investors quite a bit of confidence that as they're looking for safe havens in this very crazy world that we live in, can't think of a better adjective than that right now. China's not a good place to invest in right now. And it seems that India is more immune to the pressures that occur when the dollar is strong. So I think global investors have been looking for safe havens, and among emerging markets, it's India, and among developed countries, it's the United States. And they've been putting their money in the bond market in the U.S.
Okay, all right. Thanks so much, Mr. Yardeni, as well as Dean, for stopping by and giving us your quick comments. Let's see how this goes, but it appears we're in for a bit of a rough ride, at least in our equity markets today. Well, for the time being, let's slip into a short break. You come back, we'll have a lot of stocks that have lined up for you in our top 10 segment.